Welcome to this explainer. Okay, if you've been checking your stock portfolio lately, you might genuinely think your app is broken. Seriously. We are right in the middle of a massive, confusing, and honestly completely contradictory market divide right now. So today, we're going to decode exactly what's happening beneath the surface.
Let's dive right into this completely bizarre divergence. On one hand, you've got the blue-chip heavy Dow Jones Industrial Average, flying high, surging near an all-time record of 52,300. But right next door, the tech-heavy NASDAQ 100 is absolutely bleeding out, losing a staggering $1 trillion in market value over just 2 sessions. I mean, that is an almost unfathomable amount of wealth wiped out in 48 hours. So how can two major indices move in such radically opposite directions at the exact same time?
Section 1, the Oil and Peace Catalyst, and how geopolitics is moving markets. 20 million. That's a huge number, right? Well, according to the U.S. Energy Secretary, that is the exact number of barrels of crude oil that safely exited the Strait of Hormuz in a single 24-hour period following the recent peace agreement. To put that massive number into perspective, that's roughly a fifth of daily world consumption, suddenly unblocked and flooding right back into the global supply chain.
This timeline perfectly illustrates how rapidly easing geopolitical tensions can shift the economic ground right beneath our feet. Think back to February. The Middle East conflict effectively bottlenecked a critical global waterway, and that sent panic ripping through the energy sector. Then, mid-June hits, and the Versailles Peace Framework is announced. A mere 24 hours later, stranded tankers begin exiting Hormuz under military escort. And by late June, Brent crude oil dropped below $75 a barrel, hitting levels we hadn't seen since before the war even started.
And the real-world market reaction to this was literally immediate. When the price of oil plummets, while the cost of jet fuel plummets. Travel and airline stocks absolutely surged as investors cheered the sudden drop in these suffocating fuel costs. And hey, maybe we'll actually get some cheaper summer flights out of it too, right? American Airlines jumped over 8%, JetBlue rose 4.5%, and Delta climbed 3.7%. This sudden energy relief is a really massive piece of the Dow's success puzzle. Section 2, Inflation's Lingering Shadow and May's Energy Shock. Now, to fully grasp why the market was so relieved, we actually have to rewind a bit and remember the intense pain caused just weeks prior. This conflict-driven energy shock specifically drove headline inflation in May up to 4.2%. That was a high we hadn't seen since April of 2023. And the underlying energy components? Absolutely brutal. Overall energy costs jumped 23.5%. Gasoline soared 40.5%, and fuel oil increased a massive, astronomical 58.9%. This intense inflationary pressure had the market sweating and kept the Federal Reserve leaning hawkish.
So how does all of this tie back to the Dow hitting record highs? Well, it's all thanks to this fascinating dynamic called borrowed tailwinds. This happens when an index is lifted, not because its companies are suddenly reporting massive earnings growth, but because of external macroeconomic factors. You see, dropping oil prices are feeding a strong disinflation story, which in turn pulled the 10-year Treasury yield down below 4.5%. And because the Dow is heavily weighted in traditional industrials, financials, and dividend-paying companies, it absolutely loves cheaper money. It essentially borrowed these tailwinds to glide its way to near-record highs.
Which brings us to Section 3, the Tech and AI Recalibration, or why the NASDAQ is bleeding. Meanwhile, over in the technology sector, they are facing a severe reality check. Remember that mind-blowing $1 trillion the NASDAQ 100 shed in just 2 days? Yeah, investors are growing incredibly wary of the heavy debt-fueled AI infrastructure spending by major tech companies. When you add in those lingering fears of Federal Reserve rate hikes, fueled by that hot May inflation data we just looked at, tech just gets hammered. We even saw specific market triggers like newly public AI chip designer Cerebras sinking 16% right out of the gate, all due to a highly disappointing profit margin forecast. This quote from BlackRock's Q2 Equity Market Outlook really hits the nail on the head. They note that the AI mega force is showing signs of recalibration as the opportunity set broadens. The big takeaway here, investors aren't abandoning AI altogether. No way. They're just waking up from the hype dream, reevaluating those sky-high valuations, and actively looking for sustainable growth beyond the handful of mega-cap darlings that have utterly dominated the last few years. Now, here is a truly fascinating bit of market irony for you. The Dow's historical lack of semiconductor exposure was actually its saving grace during this massive tech sell-off. The chip wobble barely even touched it. But a major change is coming. Alphabet is officially replacing Verizon in the index. This structural swap is going to hand the Dow a far larger technology footprint moving forward. Though, for now at least, the market is reading this tech addition as a net positive, further insulating the Dow's momentum.
Section 4. The Great Market Rotation. Let's look at the big picture.
Zooming out from the daily ticker shock, BlackRock's latest equity outlook captures this exact moment perfectly. They say we're entering a distinct period of reversal, rotation, and recalibration. This is absolutely crucial for your portfolio strategy because the data suggests this isn't a broad, catastrophic market crash. Instead, we are witnessing a massive structural reallocation of capital churning right beneath the surface of the major indices.
So let's break down exactly where all that capital is actually moving. Investors are getting way more price sensitive, rotating their money out of stretched tech stocks and shifting it steadily into value and cyclical components. Interestingly enough, U.S. large caps are actually lagging behind smaller caps right now. And this rotation is crossing borders too. A pro-growth election boost is making Japanese equities highly attractive, and capital is even flowing into emerging markets like Brazil, places that were previously unloved by global investors, but now offer some really compelling growth prospects.
But hold on, because all of this recent optimism, the cheaper oil, the falling yields, the grand rotation to value, it might just run straight into a brick wall. Later this week, we get the core PCE inflation data. This is the Federal Reserve's preferred inflation gauge, and the consensus actually expects core prices to speed up, showing a 0.3% increase for the month and 3.4% for the year. This is the awkward, nail-biting part. The market's been throwing a massive disinflation party based on a cheaper barrel of oil, while the core data might actually show fundamental inflation accelerating.
So I'm going to leave you with this final thought to ponder. Is this great rotation a durable new market reality driven by easing geopolitics and a broadening economy? Or is a hot inflation print about to repossess those borrowed tailwinds and send the Dow crashing back down to earth? Thank you for joining me for this explainer, and definitely keep a very close eye on how the market digests that upcoming data.